After Trump was elected as the next US president, many companies boomed in price as the tension in the markets was finally over. But not every company saw great returns after the elections. CSIQ and many other companies that specialize in solar energy, such as Jinko Solar or First Solar, saw huge price decreases. CSIQ is currently down by 10.5% since the elections, which potentially opens up an opportunity to buy the stock at low price. Now, over the past 18 years, the company is down by almost 20%, which means that when investors bought the company when the markets were greedy, they probably didn't see much return at all. But when they made their investments when the company was struggling, such as here, here, or potentially right now, they saw great returns. But why would solar go up if Trump was elected? Well, we would think that at the first glance, but speaking from historical perspective, you would think that when Obama was president, green energy stock returns would be up and oil stock returns would be down. But as we can see, when Obama was president, green energy stock returns were at negative 77% and oil stock returns were at positive 41%. Now let's have a look at the opposite. Let's have a look at Trump when he was first president. Green energy stocks were up by 309% and oil stock returns were down by 40%. Now looking at Biden, the green energy stock returns were down by 38% and oil stock returns were up by 182%. So with that in mind, let's first have a look at CSIQ historical statistics. They are a growing powerhouse, growing at a rate of 37% yearly on average over the past 15 years, which is 4% higher than the industry. We can also see that by 2050 they project an 18 terawatt cumulative solar capacity base. And one of the reasons for this is the 1.5 degrees Celsius Paris Agreement, which states that by cutting greenhouse emissions, they will lower the rising temperatures from 2 degrees Celsius to 1.5 degrees Celsius. And this isn't the only such agreement. Overall, many countries have agreed to cut emissions by 2030 to 2050, and what other way to do it than with green energy? This said, there is massive headroom for solar energy. We can see that since 2012, solar has been growing very steadily since about 2022, and in 2023 it dipped slightly. But we can see the huge potential that solar has, as it is one of the most abundant materials on Earth. One thing we really like about CSIQ is that they are present in all the major continents such as the Americas, Africa, Europe, Asia, and Oceania. Over the next years, their presence in more developed countries in Europe and in North America will be very noticeable due to the increased sentiment to lower emissions. And if we scroll a bit down, we can see that about 50% of their presence is in said developed countries. Let's now have a look at their financials. So right away we can see that they are not a dividend company and they do not currently pay out any dividends. And if we jump straight to the first pillar, we can see that currently their PE ratio is sitting at 23.37 and their 5-year average PE ratio is sitting at only 16.46, which would tell us that they would be considered undervalued compared to their earnings. And if I scroll a bit down, we can see the very nice growth in the earnings per share of the company. Now talking about growth, if we jump to pillar number 3, we can see that on average the revenue has been growing by 17.88% over the past 5 years every single year, growing from about 3.2 billion in 2019 to 7.6 billion in 2023. Now if I jump to pillar number 4, we can see the average net income growth. Now the net income growth is sitting at 6%, but as we can see the net income is much lower than the revenue of the company. In 2023 sitting at only 274 million, while the revenue was sitting at $7.6 billion. So that is something to keep an eye on. Now if we have a look at their free cash flow, we can see that the growth isn't really there. And in 2023 the free cash flow is actually at negative 840 million. Now jumping to pillar number 6, we can see that the profit margin is sitting at 16.47 on average over the past 5 years at 18.89, but overall it has been decreasing slightly over the past 5 years. Moving further, we can see that they have also been selling out shares increasing the shares outstanding by about 5 million over the past 5 years. And finally, jumping to pillar number 9, we can see that they have actually been taking on a lot of debt. In 2019, they were sitting at about 1 billion, and currently they're sitting at 2.7 billion. So that is again something to look out for. But now let's calculate CSIQ's intrinsic value. So first let's jump to the Graham's formula revised. And here we will take the 5-year earnings per share sitting at 2.80, the base PE sitting at 7, the 5-year growth estimates plugged in at 5, growth rate multiplier, average yield on A corporation bonds, and the current yield on AAA corporation bonds, and we will get an intrinsic value of $38.23, which is 68% higher than the current trading price. And if we jump to the second valuation model, the discounted cash flow model, where we take the free cash flow over the past 5 years and calculate the average growth rate, as we know the growth rate is actually sitting at a negative number. But if we take a look at the analyst growth rate projections, we can see that they predict a growth rate of 6.87%. And based on the research we did, I will calculate the growth rate of 7% into the future. Using that, I will calculate the future free cash flow, and then to calculate the present value of that future free cash flow, I have to plug in discount rate. Now, as CSIQ is still a growing company, I will plug in quite a high discount rate as I would expect a high return. And using that, I will calculate the present value of that future free cash flow, add all of that up, add any cash and cash equivalents, and subtract total debt. And as we know, the debt is quite high, so right now we are accounting for that high debt. And after that we will get an equity value, which we will divide by the shares outstanding and get an intrinsic value of $32.86. Again, quite higher than the current trading price and quite similar to the intrinsic value we got in our Graham's formula. And now finally jumping to the multiples valuation, where we will compare CSIQ to its competitors. So we'll take their current stock prices and divide by their earnings per share to get their PE ratios. Then we will average out these PE ratios and multiply by the earnings per share of CSIQ and get an intrinsic value of $8.14, which is actually quite lower than the current trading price of the company, showing us that CSIQ wouldn't be considered overvalued compared to its peers. Now we will skip the dividend discount model as CSIQ doesn't currently pay out any dividends, and we will arrive straight to the ultimate intrinsic valuation. Here we will average out the 3 valuation models we did and get an intrinsic value of $26.41, which is 117% higher than the current trading price of $12.15. And if I plug in a margin of safety of 20%, I will still get an acceptable buy price at $21.30. We can actually plug in a margin of safety of up to 40% and we would still get an acceptable buy price at $15.84. And finally, let's have a quick look at what TipRank says about CSIQ. So currently, the company has a 44.76% upside with an average price target of $17.40, with an average sentiment to hold the company with 2 buy ratings, 2 hold ratings, and 2 sell ratings. Overall, CSIQ has a lot of potential with the growing demand for solar power. But as mentioned, it is definitely on the riskier side, with low growth free cash flow and quite high debt. Now with that, if you did enjoy the video and found it helpful, make sure to leave a like and subscribe. Also, if you'd like to download the valuation spreadsheets for your own personal use, you can head to the link in the description. With that, thank you for watching.